One of the most enduring pieces of investing wisdom is the advice, never invest in a business you cannot understand. This principle has become synonymous with Warren Buffett's approach to investing, serving as a foundation for his remarkable success. By emphasizing clarity and comprehension, Buffett encourages investors to focus on businesses with transparent operations and straightforward models. This idea is also central to the broader philosophy of value investing, which prioritizes careful analysis and long-term stability over speculation. Over the years, this advice has guided countless investors, helping them avoid unnecessary risks and make more informed decisions. Its reputation as a cornerstone of prudent investing continues to influence financial strategies around the world. Many investors follow conventional wisdom, believing that certain rules are universally safe. But what if this advice, which appears straightforward and reliable, actually contains hidden pitfalls? Blindly adhering to established guidelines can sometimes lead to missed opportunities or unexpected risks. It's important to critically examine the reasoning behind these rules and consider whether they truly serve your unique financial goals. By questioning the status quo, you may uncover nuances that could significantly impact your investment outcomes. In some cases, what seems like a protective measure might inadvertently limit your potential for growth. Personal biases often shape the way we interpret information, leading us to favor data that confirms our existing beliefs while overlooking contradictory evidence. This tendency can result in a false sense of understanding, where confidence is mistaken for competence. When investors misinterpret their grasp of a market or asset, they may ignore warning signs or fail to recognize emerging risks. Such intellectual blind spots can leave portfolios vulnerable to unexpected downturns or missed opportunities. Recognizing and challenging these biases is crucial for making informed decisions and protecting investments from avoidable mistakes. Many investors encounter famous quotes and often interpret them in a straightforward, literal manner. This approach, while appealing for its simplicity, can lead to misunderstandings about the true intent behind the message. By focusing only on the surface meaning, investors may overlook crucial nuances and context that are essential for sound decision-making. Such oversimplification can result in misguided strategies and unrealistic expectations. The fundamental flaw lies in ignoring the complexities of investing, which rarely align with one-size-fits-all advice. A deeper analysis is necessary to fully appreciate the wisdom and limitations embedded in these quotes. Many people assume that because a product or service is widely recognized, they fully understand the business behind it. This common interpretation equates consumer familiarity with genuine insight into how a company operates. However, being a frequent user or observer does not necessarily reveal the complexities of business strategy, financial health, or operational challenges. This misconception often leads to false confidence, where individuals believe their personal experiences are sufficient to assess a company's prospects. In reality, true business understanding requires a deeper analysis of market dynamics, competitive positioning, and internal decision-making. Relying solely on surface-level familiarity can result in overlooked risks and missed opportunities. Many investors assume that their professional background or personal experiences automatically equip them to evaluate a business. For instance, someone who has worked in retail might believe they fully grasp the complexities of launching a new retail chain, overlooking factors like supply chain logistics or market differentiation. Similarly, an investor who frequently uses a particular app may feel confident in assessing tech startups, even though they may not understand the challenges of scaling software or managing user data. These assumptions can lead to overconfidence and missed risks, as real business expertise often requires specialized knowledge and a deep understanding of industry nuances. By relying solely on personal experience, investors may overlook critical details that could impact a company's success. Many people assume that using a product or being familiar with an industry means they understand how its business operates. However, there is a significant difference between being a customer and being an owner. As a customer, your perspective is shaped by personal experience and satisfaction with the product or service. Owners, on the other hand, must consider factors such as revenue streams, costs, competition, and long-term strategy. Familiarity with a product does not reveal the complexities of supply chains, pricing models, or market dynamics. True understanding of a business model requires insight into how the company generates profit and sustains growth, which goes far beyond the user experience. Intellectual shortcuts, such as relying on popular opinions or superficial analysis, can be tempting when making investment decisions. These shortcuts often create a false sense of security, leading investors to believe their choices are well-founded without thorough research. Overconfidence in simplified strategies may result in overlooking critical risks or market complexities. As a consequence, investors might be exposed to unexpected losses or missed opportunities. Recognizing the limitations of quick judgments is essential for developing a more robust and informed approach to investing. By taking the time to analyze information deeply and question assumptions, individuals can better safeguard their financial interests. Warren Buffett and Charlie Munger have a distinctive approach to the concept of understanding in investing. For them, true understanding goes beyond surface-level knowledge or familiarity with a business. It means being able to reasonably predict how a company will perform over time, especially in terms of its long-term economics. This predictability is crucial, as it allows investors to make informed decisions with greater confidence. Buffett and Munger emphasize that only businesses with clear, durable competitive advantages and stable financial prospects should be considered. In their view, understanding is about recognizing patterns and anticipating future outcomes, rather than relying on speculation or short-term trends. When evaluating a business, investors must address several fundamental questions to gain true insight. First, what is the company's competitive advantage, and how sustainable is it over time? Next, understanding the business economics is crucial. This includes analyzing revenue streams, cost structures, and profit margins. Identifying key risk factors, such as market volatility or regulatory challenges, helps investors anticipate potential obstacles. Finally, maintaining valuation discipline ensures that investment decisions are grounded in realistic expectations and sound financial analysis. Together, these questions form the foundation of a thorough investment assessment. Identifying a business's moat is crucial for understanding its long-term competitive advantage. A moat represents the unique qualities or assets that protect a company from competitors, such as strong brand recognition, proprietary technology, or cost leadership. By analyzing the core drivers of profitability, such as pricing power, operational efficiency, and customer loyalty, investors and managers can assess how sustainable a company's success truly is. Recognizing these factors helps in forecasting future growth and resilience, especially in changing market conditions. Ultimately, a clear understanding of both the moat and profitability drivers enables more informed strategic decisions and investment choices. Evaluating an investment requires more than just optimism. It's essential to articulate the bear case, or the reasons why the opportunity might fail. By thoroughly considering potential risks and downsides, investors can avoid blind spots and make more balanced decisions. Recognizing warning signs and understanding when the risks outweigh the potential rewards is a critical skill. Sometimes, the most prudent move is to walk away, preserving capital for better opportunities. This disciplined approach helps investors avoid costly mistakes and maintain long-term success. Ultimately, knowing when to say no is as important as knowing when to say yes. Many people believe that simply being a consumer of a product or service automatically makes them an expert in that industry. This myth can lead to overconfidence and flawed decision-making. In reality, developing genuine expertise requires rigorous analysis, careful study, and a willingness to admit what you do not know. True competence is built through humility and a disciplined approach to learning, not just casual familiarity. By acknowledging the limits of our understanding and continuously seeking deeper insights, we can more accurately define our circle of competence. This mindset helps prevent costly mistakes and fosters better judgment in both personal and professional pursuits. The popular interpretation of the quote often encourages individuals to focus their resources on a single area or investment. While this approach may seem efficient, it can lead to dangerous concentration risk, where too much depends on the success of one outcome. Overconfidence may develop as people become convinced that their chosen path is the only viable option. This mindset can cause them to overlook potential pitfalls and ignore the benefits of diversification. In volatile environments, such a strategy increases vulnerability to unexpected setbacks. By relying heavily on one asset or idea, individuals expose themselves to greater losses if things do not go as planned. Recognizing these risks is essential for making balanced and informed decisions. A true value investor begins with humility, acknowledging that initial assumptions may be flawed or incomplete. This mindset drives a commitment to thorough research and careful analysis, rather than relying on gut feelings or market hype. By questioning every detail and seeking to understand the underlying fundamentals, value investors aim to uncover opportunities others might overlook. Their approach is methodical, patient, and grounded in evidence. This discipline helps them avoid costly mistakes and make informed decisions that stand the test of time. Ultimately, the value investor's strength lies in their willingness to admit what they don't know and their dedication to learning more. Instead of assuming expertise based solely on what feels familiar, it's important to approach your circle of competence with humility and dedication. True understanding is built through continuous learning, asking questions, and recognizing the limits of your knowledge. By putting in the hard work to expand your skills, you create a solid foundation for sound decision-making. This process requires patience and a willingness to admit when you don't know something. Over time, your competence grows not from comfort, but from genuine effort and curiosity. Such an approach leads to more reliable judgments and better outcomes. True safety, peace, and ease in investing are not simply the absence of risk, but the outcome of thoughtful preparation and disciplined strategy. These qualities emerge when investors conduct deep analysis, thoroughly understanding the businesses and markets they engage with. By seeking a margin of safety, investors ensure that their decisions are buffered against unforeseen setbacks, providing a cushion that protects their capital. Long-term confidence is built through patience and conviction, allowing investments to grow and weather short-term volatility. Together, these elements create an environment where investors can feel secure, make informed choices, and pursue lasting financial success. The phrase, "understand your business," is often repeated, but its true meaning goes far beyond surface-level familiarity. It serves as a reminder to approach every aspect of your work with humility, recognizing that there is always more to learn. This mindset encourages disciplined exploration and continuous improvement, rather than settling for easy answers or complacency. Embracing this lesson means acknowledging gaps in your knowledge and actively seeking to fill them. Ultimately, understanding your business is not about finding comfort, but about committing to ongoing growth and adaptation in a constantly changing environment. Taking time to reflect on your own circle of competence can be a valuable exercise. By understanding the areas where your knowledge is strongest, you can make more informed decisions and avoid unnecessary risks. Engaging with a community of like-minded individuals offers opportunities to share insights, ask questions, and learn from diverse experiences. This collaborative approach not only broadens your perspective, but also helps you identify gaps in your understanding. As you continue to explore and challenge your boundaries, you'll find that your circle of competence can expand over time. Remember, growth often comes from curiosity and meaningful interaction with others. There are countless investing quotes and rules that have shaped the way people approach financial markets. If you know of any famous sayings or principles that you find insightful, consider sharing them for future analysis and discussion. Exploring a variety of perspectives can deepen our understanding of investment strategies and decision-making. By examining different viewpoints, we can uncover valuable lessons and timeless wisdom. Your suggestions may help highlight important concepts that deserve further attention in upcoming segments. Building lasting wealth is not a sprint, but a marathon that demands patience and perseverance. Humility plays a crucial role, reminding us to acknowledge what we do not know and to remain open to new ideas and perspectives. Continuous learning allows us to adapt to changing circumstances and seize opportunities that might otherwise go unnoticed. By embracing these qualities, we lay a strong foundation for financial growth that endures over time. Ultimately, true wealth is cultivated through steady progress, thoughtful decisions, and a willingness to learn from both successes and setbacks.